Ever been in a situation where you needed a quick loan, but the whole process felt like navigating a financial maze? You know, mountains of paperwork, long waiting times, and then the big question mark, what's the actual cost? Specifically, if you're looking at options like branch, you're probably wondering, what is the interest rate on branch loans really? That's exactly what we're diving into today. Because let's be honest, understanding the cost of borrowing is crucial. It's not just about getting the money, it's about knowing what you're signing up for and making sure it fits your budget. Now, before we get into the specifics of Branch's interest rates, let's quickly recap why people opt for mobile loan apps like Branch in the first place. Traditionally, getting a loan from a bank involves a lengthy application process, credit checks, and often requires collateral. This can be a major hurdle, especially for those with limited credit history or urgent financial needs. Mobile loan apps like Branch offer a streamlined alternative. They typically involve a quick online application, often using your phone data to assess your creditworthiness. This means faster approval and disbursement of funds, making them a convenient option for short-term financial needs. But with this convenience comes a crucial question: what's the catch? Or, more specifically, what are the interest rates? Because while the speed and ease of access are attractive, understanding the cost of borrowing is paramount. After all, you don't want to end up paying significantly more than you borrowed in the first place. So, let's address the elephant in the room. What is the interest rate on branch loans? The short answer is, it varies. There's no single, fixed interest rate across the board. Several factors influence the interest rate you'll be offered. One of the primary factors is your credit score, or rather, how Branch assesses your creditworthiness. Since these apps often don't rely on traditional credit bureaus, they use alternative data sources. This could include your phone usage, transaction history, and repayment behavior within the app itself. The better your profile, the lower the interest rate you're likely to receive. Another factor is the loan amount and the repayment period. Generally, smaller loan amounts with shorter repayment periods might have higher interest rates compared to larger loans with longer terms. This is because the lender takes on more risk with shorter-term loans, as there's less time for them to recoup their investment. The specific country or region you're in also plays a role. Interest rates are influenced by local market conditions, regulations, and competition among lenders. So, the interest rates offered in one country might differ from those in another. Now, you might be thinking, this is all very general. Can you give me some actual numbers? While providing exact numbers is difficult due to the variability we just discussed, we can talk about typical ranges. Branch, like many other mobile lending platforms, often expresses its interest rates as a percentage per month. This can range from single digits to sometimes over 20% per month. It's important to clarify that this is a monthly rate, not an annual percentage rate, APR. To illustrate this, let's take an example. If you borrow $100 with a monthly interest rate of 10%, after 1 month, you'll owe $110. After 2 months, assuming you haven't made any payments, you'll owe $121, and so on. This is a simplified example, and the actual calculations might be slightly different depending on Branch's specific terms. This brings us to a crucial point. It's absolutely essential to carefully review the loan terms and conditions before accepting any loan. Branch, like other reputable lenders, provides this information within the app. Look for details on the interest rate, any applicable fees, the repayment schedule, and any penalties for late payments. Don't just skim over these details. Take the time to understand them fully. If anything is unclear, reach out to Branch's customer support for clarification. It's always better to ask questions up front than to face unexpected charges later on. Now, let's address a common misconception. Some people assume that because mobile loan apps offer quick and easy access to funds, they are inherently predatory or have exorbitant interest rates. While it's true that some lenders operate unethically, many reputable platforms, including Branch, aim to provide a convenient financial service. However, the convenience and speed come at a cost. The interest rates on these loans are generally higher than traditional bank loans. This is due to several factors, including the higher risk associated with lending to individuals with limited credit history and the operational costs of running these platforms. Therefore, it's crucial to use these loans responsibly. They are best suited for short-term, urgent financial needs, not for long-term borrowing or funding discretionary expenses. Before taking out a loan, carefully assess your financial situation and ensure you have a solid plan for repayment. Consider these loans as a tool to bridge a temporary financial gap, not as a solution to ongoing financial difficulties. If you find yourself constantly relying on short-term loans, it might be a sign that you need to address underlying financial issues. So, to summarize, the interest rate on branch loans varies depending on several factors, including your creditworthiness as assessed by the app, the loan amount, the repayment period, and your location. It's typically expressed as a monthly percentage and can range significantly. Always review the loan terms carefully before accepting any loan. Remember, mobile loan apps like Branch offer a convenient option for short-term financial needs, but it's crucial to understand the cost of borrowing. Use these services responsibly and ensure they align with your overall financial plan. With that said, thanks for watching, and until next time.